Customer calls in, not just any customer. This lady is 72 years old. And the moment she starts talking, I already knew what she was calling about. She starts by saying that she got a letter and she didn't understand what the letter meant, but she thinks it's trying to tell her that her policy is about to be terminated. And the bad thing about it is that she is absolutely correct. She starts asking questions about her policy, what it's saying, why is this letter being sent to her, and it says a date. It's telling her policy is going to terminate in February of 2025. So in order to give myself time to prepare to explain this type of information, I say, ma'am, I do see your letter. I'm just going to take a minute to review it, and I'm going to place you on a really brief hold. So I place on a brief hold, I gather all the information, and I start to prepare myself to explain to her that because her policy is running out of cash value, it is about to terminate itself, guaranteed February 2025.
She's got a tough job.
Get back on the phone. I pretty much explained to her that your policy is running out of cash value. She says, well, I've had this policy since 1987. And I say, yeah, and I understand you have had that policy since 1987. You've done nothing wrong. You've paid your premiums on time, every month, faithfully. However,
somebody didn't educate her
the policy is
properly.
running out of cash value because you've been paying the same premium every year since 1987. You haven't increased it. You haven't put any more money into your cash value. Therefore, there's not enough money to offset the cost of insurance. So now your policy is about to end next year in February. And she goes to say, well, what can I do? Is there anything I can do to keep my policy? Can I convert it? Can I put more money into it? Is there anything I can do?
It's a specific type of policy, though.
There's literally nothing you can do. The only thing she can do is go to an agent, have them quote her a term policy, and see how much that would cost her. But essentially, she has to start from scratch. This type of policy is a universal life policy, and this is very common. We get calls like this all the time.
That would cost her
where a 72-year-old person,
hundreds of dollars per month.
80-year-old person, even a 60-year-old person,
so she said this is a universal life policy.
Years, thinks that just
this is
paying the premiums on time every month is going to keep the policy.
There's a difference.
And it does not. At the end of the day, she was very upset. She was very broken. She felt like she had put all of her money into this policy for nothing. And she was like, well, I just want to cash it out.
Cost of insurance does go up, and it will eat into your cash value.
Policy. I proceed to tell her, we can cash the policy out, but the only thing about it is that your surrender amount has dropped down to $70. She only had $70 in her cash surrender amount because the policy picks at it in order to offset the cost of insurance.
So the big difference here is universal insurance is not made to accumulate a lot of cash value. As a matter of fact, it's mostly just for death benefits. But as the client gets older, the cost of insurance does go up. Therefore, there should be an increase in the premiums. If you just keep paying $49, $47 per month for the next 30 years, eventually the cash value built up inside that policy will be eaten away in order to pay for the cost of the raising insurance. Now, index universal insurance is a little different. You have a higher cash accumulation, and if it's structured properly, they're going to lower the death benefit to the legal minimum, therefore reducing the cost of insurance and allowing your cash accumulation to happen much quicker. Now, over the lifetime of the policy in an index universal life insurance policy, the cost of insurance does go up as you get older because it's built on a term framework, a renewable term framework. But here's the difference, and a lot of people don't understand this. The carrier will charge you only for the difference of what the death benefits and the cash value is. So as your cash value accumulates over the years, the carrier is going to charge you for less total cost of life insurance. Therefore, the cost of insurance actually gets cheaper in an IUL than getting more expensive. Make sure you're sitting with a financial professional that is an expert in the area of financial literacy and compounding interest and IULs versus ULs versus whole life. You have to sit with somebody that knows what they talk about. You can't just sit with one person that is a specialist in whole life and hates IULs, or one person that's an IUL maniac but hates whole life. You got to sit with somebody that does all of them. Our firm specializes in both sides of the spectrum. We do whole life, we do term, we do final expense, mortgage protection, and IULs. So if that's something you'd like to entertain, please click the link in the bio. I'd love to sit down with you, educate you, and see if there's a good fit to work together and hopefully get you compounding some of your money.